Imagine reading market structure with the precision of Charles Dow and timing your entries using the same candlestick secrets that made Charles and Hommer a legend. Today, I'll show you how combining their methods creates a deadly scalping strategy that works on any market. Do you know this man? His name is Charles Dow, and more than 100 years ago, he saw something in the markets that nobody else could see. While everyone else was guessing, reacting, panicking, Dow discovered a revolutionary truth about price. Every market follows a predictable structure. Trends aren't random, they move in phases. And price reveals everything long before the news ever does. This wasn't an opinion, it was his life's work, and today, it forms the foundation of every professional trading system. There are two discoveries Dow made that completely change the way you read the market, and they are the foundation of this scalping strategy. The first and most important discovery is this: all information is already reflected in the price. Everything you can imagine, news, fundamentals, economic conditions, trader emotions, it's all already baked into the chart. Which means you don't need to follow the news. You don't need to predict the economy. You don't need insider information. You just need to read the chart. Because the chart already knows everything the market knows. And in just a moment, I'll show you exactly how this principle becomes the foundation of a deadly scalping system that works on any market and any time frame. So don't skip. What comes next is extremely important. The second discovery is that the market always moves in 4 phases. Every market, forex, crypto, stocks, goes through the same repeating cycle over and over again. Accumulation phase. Price moves sideways at the bottom. Smart money is accumulating positions quietly. Markup phase. Price exits the range and begins making higher highs and higher lows. This is the trending phase, the easiest phase to make money. Distribution phase. Price moves sideways at the top. Smart money is selling into strength. Markdown phase. Price breaks down and starts making lower highs and lower lows. The downtrend begins, and the entire cycle repeats. These are not theories, they are the DNA of the financial markets. And if you understand these phases, you automatically understand where the best trades are. Years later, Richard Wyckoff refined Dow's principles by showing how smart money manipulates each phase. Right before a major move begins, smart money creates a trap, a liquidity sweep. Before the accumulation phase ends, a spring occurs. A spring is a fake break below support, a liquidity grab, a trap to shake out sellers, the final action before the uptrend begins. It's smart money's last discount before pushing price higher. Before the distribution phase ends, an upthrust occurs. An upthrust is a fake break above resistance, a sweep of the highs, a trap for late buyers, the final action before the downtrend begins. It's the perfect mirror of the spring, but at the top. Okay, let me ask you a real question. Do these principles still work today? To answer that, let me show you something on the chart. Recently, Bitcoin crashed hard. Suddenly the internet started shouting, "Crypto is dead! The bull run is over! Bitcoin bubble pop!" Analysts blamed low liquidity, macro fear, interest rates, inflation, but guess what? You don't need 10 explanations, you only need 2 Dow principles. Look at the Bitcoin daily chart. In 2024, the market was clearly in an accumulation phase. Then a spring occurred, a classic liquidity sweep. Right after that, Bitcoin entered a markup phase and started trending strongly. Later, price began ranging again near the top. This was the distribution phase. And inside this distribution, we got an upthrust, a fake breakout above the highs. And what happened next? A markdown phase. That's Dow theory in action. After the markdown, Bitcoin started ranging again, forming another accumulation phase. Then, once again, a spring formed. After the spring came a markup, followed by another distribution phase, another upthrust, and another markdown. No philosophy, no indicators, just pure Dow theory. Bitcoin was in a distribution phase. Smart money created a liquidity sweep, the upthrust, and the market dropped exactly as expected. So right now, Bitcoin is in a bear market. If you understand Dow theory, you immediately understand what happened to Bitcoin. You could have spotted the distribution, recognized the upthrust, and taken an early short before the big move down. That's the power of Charles Dow. And listen, this isn't even today's lesson, alright? I only showed you this to prove how powerful Charles Dow's ideas still are, even after more than 100 years. Because in just a moment I'm going to reveal something even better, how to combine Charles Dow to read market structure with absolute clarity, and Charles and Hommer to time your entries with precision using candlestick psychology, to create one of the simplest, cleanest, and most profitable scalping strategies you will ever learn. So do not skip this part, stay with me, because what you're about to see will change the way you scalp forever. Dow theory says the market only has 3 possible states: uptrend, downtrend, and sideways. And if you want to scalp like a professional, you must understand how each one works, because every powerful setup starts from one of these 3 conditions. Let's break them down in a way that actually helps you trade. An uptrend simply means the market is creating higher highs and higher lows. Think of it as a staircase where every new step is built slightly above the previous one. When this happens, it's a sign that buyers are stronger than sellers, demand is higher than supply, traders are willing to pay more, sellers can't defend previous highs. This imbalance creates the clean conditions we love to scalp. An uptrend isn't one straight line. It's made of 2 repeating movements, an impulsive move upward and a retracement back downward. The impulsive move is that strong, aggressive burst upward, the one that defines the trend. Why does it happen? Heavy buying from institutions. Big players accumulate positions, pushing price fast. Breakout traders jump in. When price breaks previous highs, momentum traders enter expecting continuation. Stop losses get triggered. Sellers who were betting against the market get stopped out and must buy back their positions, adding fuel to the move. FOMO traders join late. As price accelerates, emotional traders jump in just to not miss the move, pushing price even higher. That's why impulsive waves are fast, clean, and powerful. A retracement is simply a pause inside the uptrend, a small decline that resets the market before the next impulsive move. Retracements happen because profit-taking begins. Traders who bought low start securing gains, reducing buying pressure temporarily. Price becomes expensive after a fast move. Many traders don't want to buy at the top, so the market naturally cools down. New buyers wait for a discount. Smart money doesn't chase moves, they wait for price to pull back to a better level, and that's where the best trades happen. If an uptrend is like climbing a staircase, a downtrend is the opposite. It's like walking down an escalator that's moving faster than you expected. Price keeps forming lower highs and lower lows, showing that sellers are firmly in control and buyers can't defend previous levels. A downtrend has the exact same internal structure as an uptrend, just flipped upside down. Impulsive move in the direction of the trend, a sharp decline driven by strong selling pressure, retracement move against the trend, a temporary bounce before the market continues lower. Understanding these 2 waves is essential for scalpers because the cleanest short setups always appear inside these retracements. The impulsive wave in a downtrend is that fast, aggressive fall that instantly tells you sellers dominate the market. Why does this happen? Heavy selling pressure. Institutions, swing traders, and algorithms unload positions, pushing price down quickly. Breakdown momentum. When price snaps below a key support level, more sellers jump in, expecting continuation. Stop loss cascades. Buyers who place stops under support get triggered, and their forced exit adds even more downward pressure. Fear and panic selling. As the drop accelerates, emotional traders rush to close long positions, fueling the decline even further. This is why impulsive moves in a downtrend are fast, violent, and powerful. The retracement inside a downtrend is nothing more than a small rally before sellers step back in. These countertrend moves happen because short sellers take profits. Traders who entered early start closing positions, causing a small upward bounce. Smart sellers wait above. Professional traders don't chase price downward. They wait for a pullback to re-enter at better prices. Sideways market. This is the phase where more traders lose money than in any other condition. A sideways market forms when price moves between clear horizontal highs and lows, showing that buyers and sellers are perfectly balanced. Neither side has enough strength to push the market into a trend. It's the market's resting phase, a zone where price is gathering energy before the next big directional move. Think of it like a constant tug of war. Buyers pull and price moves up. Sellers pull and price moves down. But neither side truly wins. This is why the sideways phase often feels confusing if you don't know what you're looking for. And this is also where traders make a huge mistake. They jump into every small breakout. They try to predict the next move too early. They get trapped by fake moves on both sides. The key to trading ranges is not to react to every spike. It's to patiently wait for the market to show which side finally takes control. Later, when we bring in Hommer's candlestick psychology, you'll see exactly how to avoid these traps and enter only when probability is on your side. Take a look at this chart. You can clearly see that the market is trending upward. So the very next question you must ask is, are we in an impulsive move or in a retracement move? This single question can be the difference between catching a perfect entry or buying at the absolute worst moment. In this example, the market is currently in a retracement phase. This tells you immediately, buyers already secured profits, price is temporarily pulling back, momentum is cooling down. So what do? You don't buy yet. You wait for the retracement to finish before even thinking about an entry. This is how professional traders avoid buying at the top. Now look at the second chart. Here, the market is clearly trending downward. So again, ask the same question. Is price in an impulsive move or a retracement move right now? In this example, price is in a strong, impulsive move downward. This means sellers are dominating, momentum is strong, but a retracement can appear at any moment if sellers start taking profits. And that retracement is where the cleanest short entries appear. Understanding whether price is in an uptrend or a downtrend tells you what direction to trade, but understanding whether it's an impulsive or retracement move tells you when to trade. Now that you understand how trends work, the next question becomes, how do you recognize when a retracement is ending and a new impulsive move is about to begin? To do that, we must go back to one of the most important concepts in technical analysis. Support and resistance. Okay, let's simplify it. Support is a price level where buying pressure is strong enough to stop price from falling lower. It's the zone where buyers step in and push price upward. Resistance is a price level where selling pressure is strong enough to stop price from rising. It's the zone where sellers take control and push price downward. These levels are essential because they help us identify where an impulsive move is losing strength, where a retracement is likely to end, where the next strong move is about to begin. Imagine the market is trending upward, forming higher highs and higher lows. Eventually, price reaches a resistance level, a zone where sellers begin to step in. Here's what typically happens at resistance. Early buyers take profits. New sellers enter. Price begins to slow down. Rejection wicks start forming. These signals tell you something important. The impulsive move is weakening. A retracement is likely to start. Once price begins pulling back, your next job is to identify where this retracement might end. And one of the best areas to watch is a previous resistance level that now acts as support. At this new support level, buyers return, the pullback ends, and the next impulsive move begins. This is where traders look for fresh buying opportunities to join the uptrend. Now let's flip the logic. The market is trending downward, creating lower highs and lower lows. Eventually, price reaches a support level where some sellers take profits. Buyers attempt to push price higher. The decline slows down. Bullish rejection wicks appear. These are signs that the impulsive drop is ending. A retracement to the upside is about to begin. As price moves upward, your next step is to locate the next resistance. A logical area is a previous support level that may now act as resistance. When price reaches this zone, something very important often happens. Price spikes above the level, sweeps liquidity, then closes back below the zone. This is a fake breakout, a liquidity grab. And this liquidity sweep is the signal that the retracement is ending. A new impulsive move downward is beginning. This is where high probability short entries appear. At this point, you've already learned the foundations that most traders never master. You now know how to immediately read the trend. If the market is trending up, you look for buying opportunities. If the market is trending down, you focus on selling opportunities. If the market is ranging, you skip it. This strategy performs best in trending conditions. Just these rules alone eliminate more than half of the bad trades beginners make. But you didn't stop at just identifying the trend. You also learned how to spot the end of a retracement and the beginning of a new impulsive move. And that skill is gold. Because once you know when a pullback is ending, you know exactly where the next powerful move will start. That's your entry, that's your opportunity. Mastering these basics already gives you about a 65% probability edge before adding any indicators or confirmation techniques. But now we need the final ingredient, and that is your trading signal, the exact moment you pull the trigger. Look at this downtrend. Price is making lower highs and lower lows. We have a strong impulsive move down, followed by a retracement, then another impulsive move, another retracement, another impulsive move, and once again a retracement. The last impulsive move breaks support, and the market begins another pullback right back into that same level. So far, everything is textbook perfect. We already know where the retracement should end, at the new resistance level that was previously support. But here's the real question. How do you know the retracement has actually finished? How do you know the next impulsive move downward is about to begin? This is where 99% of traders get confused. This is where most people enter too early or far too late. To avoid that, we use confirmation signals. Look at what happens here. The market reaches the resistance level, gets rejected, and prints a clear confirmation candle. And right after that signal, the market drops again, creating a fresh impulsive move downward. So where did this confirmation come from? From Homer's candlestick method. His signals tell us exactly when the retracement ends. Let me show you how it works. Before we dive into the trading signals, we need to meet the man who mastered market psychology long before computers, indicators, or Wall Street even existed. His name is Charles and Hommer, and if you've never heard of him, that's because the trading world has forgotten its greatest genius. Hommer lived in the 1700s, during a time when traders didn't have screens, charts, or anything close to what we have today. Yet he became so skilled at reading market behavior that he reportedly earned the equivalent of over $10 billion in today's money. How? Using nothing but candlestick patterns. I've spent months digging into Homer's original work, his philosophy, his rice trading records, and the principles behind the patterns we still use today. And his message is incredibly simple: price action is just human behavior written on a chart. If you understand people, you understand the market. Today, I'm going to show you the exact candlestick signals Homer used, the same signals that helped him dominate the markets for decades. And once you learn them, you'll be able to spot the end of a retracement, the beginning of an impulsive move, the exact candle where smart money enters, the perfect moment to execute your trade. These patterns require no indicators, no guessing, no complicated tools. They work in forex, crypto, stocks, anything that moves, because human psychology never changes. Now let's talk about the first candlestick pattern Charles and Hommer relied on, the one he used to time his entries with almost supernatural accuracy. It's called tonkachi, which literally means the hammer in Japanese. Homer discovered something incredibly powerful when the market has been falling, and suddenly a candle appears with a small body near the top and a long lower wick. That candle is not random, it's the market shouting that sellers have failed. Homer wrote, "When the shadow grows long below, the market is telling you the fall is finished." Why? Because during that candle, sellers pushed the market down aggressively, but buyers came in with even more strength and forced price right back up. That long lower shadow isn't just a wick, it's buyer strength, seller exhaustion, and a shift in momentum. Today, we call this candle a hammer or bullish pin bar, but the psychology is exactly the same as it was 300 years ago. Rejection of lower prices, buyers stepping back in, a potential bullish reversal, high accuracy when it forms at a key support or demand zone. And now let me show you exactly how this works in our strategy. Let's take a clean example of an uptrend. The market is trending upward. Price is forming higher highs and higher lows. Buyers are clearly in control. We get an impulsive move, breaking resistance. Price pushes up strongly and breaks above a previous resistance level. That resistance becomes new support. This is a classic Dow theory concept. Old resistance becomes support once broken. Price retraces back to that level. This retracement is normal. Buyers take profits, momentum cools down, we expect the pullback to end at the new support zone, but we still need confirmation. And then the tonkachi appears. A candle forms with a long lower wick, a tiny body near the top, clear rejection from the support zone. This is exactly what Homer looked for. During that candle, sellers tried to break support and they failed. Buyers came in aggressively and pushed price back up. That tonkachi tells you the retracement is over, smart money has stepped back in, a new impulsive move is about to begin. This is your entry. This is where you buy. Not earlier, not later, right when the market confirms buyer strength. Now that you've seen the tonkachi, the candle that reveals where buyers take back control, let's flip the script and look at its opposite. Meet the nagareboshi, which means the falling star in Japanese. And trust me, when you see this candle at the wrong place on a chart, it's a warning you do not want to ignore. The nagareboshi forms after a strong uptrend, and visually it's the complete opposite of a tonkachi, a small body near the bottom. A long upper wick sitting high in the trend, right where buyers feel invincible. But the psychology behind this candle is what makes it truly powerful. Because this candle tells a very different story. Buyers tried to push price higher. For a moment it looked like they succeeded, but sellers stepped in aggressively and rejected every single higher price, and buyers couldn't defend the top. That long upper wick is not just a wick. It's buyer weakness, it's seller dominance. It's the market saying, enough, this move is out of fuel. In his writings, Charles and Hommer described this phenomenon with a line that is still brilliant today. When a light burns too bright, it cannot last until dawn. What he meant was simple. When the market explodes upward too fast, when emotions peak, when euphoria kicks in, the trend doesn't end quietly, it collapses sharply. And the nagareboshi is that final spark before the flame goes out. Let me give you a clear example so it sticks. The market is in a strong downtrend. Price is making lower highs and lower lows, and sellers are in full control. Price breaks a support level. We get a strong, impulsive wave pushing through a key floor. That support turns into new resistance. Everything is still bearish. This is classic downtrend structure. Sellers take profits, momentum cools, price climbs temporarily back toward the new resistance. A lot of traders expect the market to continue upward and reverse. But then, the Nagare-boshi appears. Long upper wick, tiny body, clear rejection from the top. Sellers slam the door shut on buyers. This candle tells you, buyers tried to push the market higher and failed. Sellers struck back aggressively. The downtrend is still strong. Momentum is shifting back in favor of sellers. When a Nagare-boshi forms at new resistance, this is your early warning. The retracement is ending. The next impulsive move downward is about to begin. This is the opposite of the tonkachi. Instead of buyers winning the battle, sellers take full control again. Now let's talk about one of the most misunderstood candles in all of trading, yet one of the most important candles in Munehisa Hommer's entire philosophy. It's the doji. To most traders today, a doji is just indecision. But to Hommer, it was something far deeper. In Hommer's original writings, he described the doji as the market taking a breath before speaking again. Think about that. A doji forms when the market opens and closes at almost the exact same price, leaving behind that thin, cross-shaped candle. This might look small and insignificant, but to Hommer, it represented a moment of balance, a temporary calm in the battle between buyers and sellers. And what happens right after this calm moment often sets up the next major move. When a doji forms after a strong bullish or bearish trend, it becomes a message. Momentum is fading, power is shifting. If buyers were dominating and a doji forms, it means buyers are losing strength. If sellers were in control and a doji forms, it means the sell-off may be cooling. In these situations, Hommer didn't guess, he didn't rush, he waited for the next candle. Because the candle that comes after the doji is often the one that confirms the reversal, or confirms that the trend still has fuel. This simple patience is something modern traders rarely practice. Now here's the part most traders miss. When a doji forms in the middle of a strong trend, it's not a reversal signal. It's the market saying, hold on, let me gather strength. This type of doji creates the perfect window for smart traders to enter the trend, not at the extreme highs and not at the extreme lows, but during the moment of balance before the next impulsive move. Hommer used this pause as an opportunity. It's like entering a moving train during a slow moment instead of trying to jump on when it's speeding. Let's walk through a perfect real chart scenario where the doji gives you the exact confirmation you need to enter. The chart begins with higher highs, higher lows, strong, bullish, impulsive waves. Everything screams uptrend, so you already know. You only look for buying opportunities. This is your directional bias. After a strong, impulsive move upward, price starts to pull back, and now we're waiting for the retracement to end. But how do we know when it ends? With your confirmation candle. As price enters the support zone, a doji candle prints right inside the support level. This is your green light. That's your confirmation signal. Now we move to one of the most powerful candles ever used by Munehisa Hommer. A candle so meaningful to him that he believes it revealed the true heart of the market. It's called Tsutsumi, which literally means to wrap or to engulf. And trust me, when you understand what this candle really represents, you'll never look at price action the same way again. To Hommer, this wasn't just a pattern, it was a message of dominance. When a candle completely covers the entire body of the previous candle, Hommer saw it as a psychological knockout. One side wasn't just winning the battle, they were erasing the previous day's emotions entirely. He described it poetically. When one day swallows another, the market's heart has changed. That line alone tells you everything. Someone new has taken control. A bullish engulfing forms after a decline. The market is falling, sellers look in control, and then suddenly a powerful green candle appears. It completely engulfs the body of the previous red candle. This is not hesitation. This is buyers overpowering sellers with force. It's the market saying, the sell-off is done, buyers have stepped in. Hommer used this at the bottom of downtrends or at support after retracements to time entries with precision. A bearish engulfing is the mirror image. Price rallies upward, traders get excited, the last bullish candle forms, and then a massive red candle swallows it. This is sellers stepping in aggressively and wiping out buyer enthusiasm instantly. It's the chart saying, the uptrend is weakening, sellers are taking charge. Hommer used this to catch reversals early or to confirm retracement endings in downtrends. Now that you understand Charles Dow for reading market structure and Munehisa Hommer for confirming your entries, it's time to combine both and start scalping the market with precision. The beauty of this strategy is its simplicity and versatility. It works on the 1-minute and 5-minute time frames. It works on every financial market, forex, crypto, indices, stocks, and it gives you a clear, repeatable process you can follow every day. Here's exactly how you'll trade it. Step 1. Start on the 1-minute chart. This is where you read market structure in detail. You're looking for a clean trend, a strong impulsive move, a healthy retracement, and a clear Hommer candlestick signal at the end of that retracement. Once the setup appears, you check the math. Does this trade offer at least a 2-to-1 reward to risk ratio? If yes, move to the next step. If no, skip the trade. Step 2. Switch to the 15-minute chart. This is your higher time frame confirmation. Here, you use Dow theory to validate the setup. Is the 15-minute chart aligned with the 1-minute trend? Is the major structure supporting your direction? Is momentum on your side? If the 15-minute contradicts your setup, you stay out. If it aligns perfectly, you've just upgraded your trade to a high probability setup. With both timeframes aligned, you go back to the 1-minute chart and enter your trade with confidence. This eliminates hesitation, removes emotional trading, and gives you a mechanical, clear decision-making process. Let's apply everything we learned from Charles Dow and Munehisa Hommer on a real chart. Here we have US dollar, Japanese yen on the 1-minute time frame. The market is clearly trending down, strong impulsive moves, followed by smaller retracement moves, forming lower highs and lower lows. Then we see an important moment. The market makes a strong impulsive drop, breaks below this support level, that support becomes new resistance, and price retraces back to retest it. Right at that level, the market prints a doji, one of Hommer's key candlestick signals. Before anything else, we check structure. The market is in a clear downtrend, which means sellers are in control. In this context, the most logical decision is to look for sell setups, not buy setups. When price retraces into new resistance and forms a doji, it indicates hesitation and loss of buying momentum. In a downtrend, this type of doji usually signals the retracement is ending, sellers are preparing to step back in, downward momentum is likely to resume. This gives us our entry signal. Before entering, we switch to the 15-minute time frame. On the higher time frame, price broke above resistance but then closed back below it, which is a liquidity sweep. A liquidity sweep indicates a potential shift in direction and often signals that the move upward was a trap. This supports our bearish bias on the 1-minute chart. We return to the 1-minute chart. Entry at the close of the doji. Stop loss placed above the resistance level. Target at least 2-to-1 reward to risk. After entering, price resumes the downtrend and reaches the target. Why this strategy works? Because it follows a simple and logical process. Trend identification using Dow theory, entry confirmation using Hommer's candlestick psychology. Let's look at another example to reinforce the method. This is the New Zealand dollar US dollar on the 1-minute time frame. The market is clearly trending up, higher highs, higher lows, impulsive moves followed by healthy retracements. According to Charles Dow, this is a bullish market, which means buyers are in control and we should focus on buying opportunities, not selling. Now look at this moment. Price breaks above a resistance level. That resistance becomes new support. And when the market retraces back to test it, price gets rejected, giving us an entry opportunity. The signal appears at the close of a tsutsumi. According to Munehisa Hommer, a bullish tsutsumi shows buyers have completely taken back control. And when this happens right at support after a retracement, it is a strong sign that the trend is ready to continue upward. Before entering, we switch to the 15-minute chart to confirm the setup. Here's what we see. The market was previously in a distribution phase and an upthrust occurred. A classic false breakout described by both Wyckoff and Dow. After the upthrust, the market dropped into a markdown and eventually began moving sideways again, forming a new accumulation phase. Inside this accumulation, a spring appears. A liquidity sweep signaling that the accumulation phase is likely ending and that a new markup could be starting. Without understanding Dow theory, this price action can look confusing or random. But with Dow's framework, it becomes very clear. We are in an accumulation phase, the spring signals the end of that phase, a new uptrend is likely forming. This perfectly supports our bullish trade setup on the 1-minute chart. If you still doubt whether the market will reach the resistance level formed during the accumulation phase and reverse, you can simply use that level as your target on the 1-minute chart. This way, you trade with confidence and avoid unnecessary stress. Now we can return to the 1-minute chart and execute the trade. We place our entry at the close of the Tsutsumi candle, set our stop loss below the support level to give the trade enough room, and aim for a target that is twice the risk. As you can see, the target is the resistance level of the accumulation phase on the 15-minute chart. This way, even if the market reverses, you still exit the trade with a profit. Now, look at what happens next. The market moves exactly as expected and reaches our target. Alright traders, that wraps up today's lesson. If you found value in this strategy, make sure you like the video, subscribe, and turn on the notification bell so you never miss the next method I break down. Stay disciplined, stay patient, and I'll see you in the next video.